Preparing for a Treasury Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a Treasury Analyst do? A Treasury Analyst helps the business maintain liquidity, control financial risk, and use cash efficiently. In practice, I monitor daily cash, prepare short-term forecasts, support funding decisions, manage bank relationships, and help with debt, investments, FX, and reporting. The role sits between accounting, FP&A, operations, and banking partners, so accuracy and communication matter. A strong treasury function prevents surprises and ensures the company can meet obligations while optimizing returns on excess cash. While answering, focus on the treasury function's purpose: liquidity, cash visibility, risk management, funding support, banking relationships, and cross-functional coordination. Show you understand both daily execution and strategic financial discipline. Question 2. How would you build a short-term cash forecast? I build a cash forecast by starting with opening cash, then layering expected inflows and inflows by timing. Inflows include customer collections, debt proceeds, interest income, or intercompany receipts. Outflows include payroll, supplier payments, taxes, debt service, CapEx, and dividends. I reconcile the forecast to actuals, investigate variances, and update assumptions weekly or daily. The key is not false precision, it is identifying funding gaps early enough to act. Make sure to cover forecast structure, expected receipts, scheduled disbursements, opening balances, timing assumptions, actual to forecast variance analysis, and how the forecast supports liquidity decisions and borrowing needs. Question 3. Walk me through how you would determine the company's daily cash position. To determine the daily cash position, I would pull prior day bank balances, confirm cleared and pending transactions, and incorporate expected same-day receipts and disbursements. Then I would compare available cash against minimum operating liquidity and any restricted cash limits. If there is a surplus, I consider short-term investment or debt paydown. If there is a deficit, I coordinate transfers, revolver draws, or payment timing while keeping controls and approvals intact. In your answer, talk about bank balances, pending transactions, expected receipts and payments, restricted cash, minimum liquidity thresholds, intercompany transfers, and how daily positioning drives investment or borrowing decisions. Question 4. What is liquidity risk? And how would you manage it in a treasury role? Liquidity risk is the risk that the company cannot meet obligations when due, even if it is profitable on paper. I would manage it through cash buffers, reliable forecasting, committed credit lines, diversified banking partners, and clear escalation triggers. I also look at trapped cash, covenant headroom, and seasonal working capital swings. Good liquidity management is proactive. It gives management time to raise funding, reduce spend, or adjust payment priorities. Be sure to mention the risk of not meeting obligations, cash buffers, committed facilities, forecasting discipline, covenant headroom, trapped cash, seasonal cash needs, and early escalation to management. Question 5. How does working capital affect cash and treasury planning? Working capital directly affects cash because revenue and profit do not equal cash receipts. If customers pay slower, accounts receivable rises and cash falls. If inventory builds, cash is tied up before sales occur. If we extend payables responsibly, cash improves, but supplier relationships and discounts must be considered. As a treasury analyst, I track DSO, DPO, and inventory days because small movements can materially change borrowing needs. While answering, connect receivables, payables, and inventory to actual cash flow. Mention DSO, DPO, inventory days, supplier terms, customer collections, and how operating trends influence borrowing or investment needs. Question 6. What would you do if you found a discrepancy during a bank reconciliation? If I find a bank reconciliation discrepancy, I first isolate whether it is timing, data, or an error. I compare bank activity to the ledger, outstanding checks, deposits in transit, bank fees, wires, and rejected payments. Then I document the difference, contact the bank or internal owner if needed, and ensure the correcting entry is approved. I would not force a reconciliation. Unresolved cash differences can signal control failures or fraud risk. Make sure to cover investigating timing differences, comparing bank statements to the ledger, identifying fees, wires, deposits in transit, rejected payments, documentation, approvals, and not forcing unresolved reconciling items. Question 7. When would you recommend drawing on a revolving credit facility? Before recommending a revolver draw, I would assess the size and timing of the cash shortfall, minimum liquidity requirements, forecast confidence, borrowing costs, and covenant capacity. I would also check whether intercompany cash, delayed discretionary payments, or investment maturities can cover the gap. If the draw is needed, I would coordinate notice periods and approvals. The goal is to fund operations without overborrowing or creating unnecessary interest expense. In your answer, discuss forecasted cash shortfalls, minimum liquidity, borrowing costs, covenant capacity, alternative liquidity sources, notice periods, approvals, and avoiding unnecessary interest expense from overborrowing. Question 8. What are debt covenants, and why should Treasury monitor them closely? Debt covenants are lender-imposed limits that protect creditors and force discipline on the borrower. Common examples include leverage ratios, interest coverage, minimum liquidity, and restrictions on additional debt or dividends. In Treasury, I would monitor covenant headroom using current actuals and forecast scenarios, not just quarter-end numbers. If headroom tightens, management needs early warning to adjust spending, refinance, seek amendments, or avoid triggering default consequences. Be sure to mention lender protections, leverage and coverage ratios, minimum liquidity, restricted payments, covenant headroom, forecast monitoring, default consequences, and the importance of warning management before limits are breached. Question 9. How would you identify and manage foreign exchange exposure? FX exposure arises when cash flows, assets, liabilities, or earnings are denominated in a currency different from the company's functional currency. I would separate transaction exposure, like a euro payable, from translation exposure in foreign subsidiaries. Treasury can manage transaction risk with natural hedges, forwards, options, or currency matching. The first step is accurate exposure identification. Hedging a bad forecast can create risk instead of reducing it. While answering, distinguish transaction exposure from translation exposure. Cover currency-denominated payables, receivables, intercompany balances, natural hedges, forwards, options, exposure accuracy, policy limits, and the risk of hedging bad data. Question 10. How do rising interest rates affect a company's treasury strategy? Rising interest rates usually increase the cost of variable rate debt and can improve returns on cash investments. I would quantify exposure by separating fixed versus floating debt, checking repricing dates, and modeling interest expense under rate scenarios. On the asset side, I would review investment duration and counterparty limits. Treasury can respond with swaps, caps, debt refinancing, or cash allocation changes, depending on the company's risk policy and liquidity needs. Make sure to discuss floating versus fixed rate debt, repricing dates, interest expense sensitivity, investment yield, duration risk, swaps or caps, refinancing considerations, and alignment with the company's risk appetite. Question 11. What factors would you consider before investing surplus cash? When investing surplus cash, preservation of capital comes first, then liquidity, then yield. I would confirm cash is truly excess by checking forecasts, restricted cash, and upcoming debt service. Suitable instruments might include money market funds, treasury bills, term deposits, or commercial paper, depending on policy limits. I would monitor maturity laddering, credit ratings, concentration by counterparty, and access to funds. Chasing yield is never worth impairing liquidity. In your answer, prioritize capital preservation, liquidity, then yield. Mention cash forecast reliability, restricted cash, upcoming obligations, approved instruments, maturity laddering, credit quality, counterparty concentration, and investment policy compliance. Question 12. What payment controls are important in Treasury, and why? Strong payment controls reduce fraud and operational loss. I would expect segregation of duties between payment initiation, approval, and release, dual authorization for wires, vendor bank detail validation, positive pay, approval thresholds, and audit trails in the banking platform or TMS. For urgent payments, controls should not disappear. They should have documented exception approvals. Treasury is often the last line of defense before cash leaves the company. Be sure to mention fraud prevention, segregation of duties, dual approvals, bank detail validation, approval thresholds, positive pay, audit trails, controlled exceptions, and Treasury's responsibility before cash leaves the company. Question 13. How can a Treasury management system improve Treasury operations? A Treasury management system helps centralize cash visibility, payments, forecasting, bank connectivity, and reporting. Compared with spreadsheets, it reduces manual errors and gives faster access to bank balances and transaction data. I would still validate interfaces, user rights, and reconciliations because automation only works if inputs are controlled. In an interview, I would emphasize using technology to improve accuracy, speed, controls, and decision-making, rather than just producing reports. While answering, cover centralized cash visibility, bank connectivity, payment automation, forecasting support, reporting, reduced manual errors, user access controls, interface validation, and why technology should improve decisions, not just reports. Question 14. If actual cash flow differs significantly from forecast, how would you investigate it? If actual cash is materially different from forecast, I would break the variance into timing, volume, and unexpected item categories. For example, a customer receipt may be delayed, payroll may be higher than planned, or a tax payment may be missing from the forecast. I would identify the root cause, update the forward forecast, and communicate impact on liquidity. Repeated variances should lead to better assumptions, not just explanations. Make sure to cover variance analysis by timing, volume, and unexpected items. Mention customer collections, payroll, tax payments, root cause analysis, forecast updates, communication of liquidity impact, and improving assumptions. Question 15. The company is facing a near-term cash shortfall. What steps would you take? I would first quantify the size, timing, and duration of the cash shortfall. Then I would validate the forecast, review available liquidity, and identify actions such as drawing credit lines, accelerating collections, delaying non-critical payments, using intercompany funding, or liquidating short-term investments. I would communicate options with costs, risks, and approval requirements. In a real cash crunch, speed matters, but controls and stakeholder alignment still matter because mistakes can damage trust. In your answer, prioritize quantifying the shortfall, validating the forecast, reviewing available liquidity, drawing credit lines, accelerating collections, delaying discretionary payments, liquidating investments, communicating options, and maintaining controls. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.